Good morning, everyone. It's my singular pleasure to welcome you all, and it would appear that we have people from around the country and indeed from across the continent. You know, we live in a world that's changed so much that we've all become accustomed to meeting virtually. So welcome to our tomorrow event, the virtual version, where we're launching the 6th edition of our publication, where we crowd in multiple voices from across the industry to talk about the pressing issues of the day, because the long-term systemic risks that we face as humanity are simply not capable of being solved as isolated islands and individuals. So we're looking forward to a very engaging discussion from a very diversified panel, and I certainly look forward to it. I want to give you a couple of house rules as we get started. You'll see on the right-hand side of your screen, you'll see the ability to post notes in conversation. But if you'd like to ask a question, slightly to the left of that is an icon that says ask a question. Please post your questions there as opposed to the conversation. You're able to vote on a question, which will mean that question will rise further to the top, and those questions that surface to the top, meaning that they are of most interest to the majority of us, will be the ones that our panel will most likely be able to engage and address in the course of the conversation. But before I hand over to Tebogo to really get us started, there's a few thoughts I'd like to share, just given how important this gathering is and the subject matter that we'll be discussing. And it's really this whole question of how do we think about shared value? And how timely is that question of shared value? You know, we live in a world where COVID has ravaged and changed the way we interact, has ravaged and changed the ways our economies operate and serve us as participants and serve humanity generally. So this question of shared value is really about how do we build back better? I mean, it's the perennial question of the day. And as Old Mutual, we're in this somewhat unique position, because not only are we a large corporate in South Africa, we're also one of the largest fiduciary asset owners, and at the same time, one of the largest fund managers in the country and indeed on the continent, which means we deploy capital at large scale. That puts us in a unique position to facilitate this conversation. And maybe it's worthwhile giving a little bit of perspective of how we think about it. You know, as a corporate, on the one hand, we think about it in terms of the nature of products and services that we provide. We put a responsible business lens on that, and we say financial inclusion is key to building back better. And so how do we make sure that our products and services, be they savings and investment products, be they our risk products, you know, how do we make sure that they serve our clients well, and importantly, provide a fair distribution of the value that those products create between, the corporate, but ultimately, the client itself. And because we're an accumulator of capital, we've had to ask the question, how do we address the long-term ESG risks? Because we deploy capital on behalf of all our clients. And so we think about this through a responsible investment lens. And it's got two axes. On the one axis, we want to make sure that we integrate ESG considerations into all our investment capabilities, products, and solutions. And the other is to be at the cutting edge of innovation as far as making sure that a unit of capital that we deploy has the requisite impact, both in terms of creating a better, greener, socially inclusive, call it economy, and on the other hand, direct impact, right? And we're in a unique position that we have been around doing this way at scale, for 15 or 20 years, be they infrastructure funds, social impact housing funds. And so the combination of, full integration into all our traditional products, but also being at the cutting edge of innovation is how we've thought about it as a responsible investor. And then the final leg is that, again, as a corporate, through our own balance sheet, how do we invest in making South Africa a little bit better through our, social responsibility investment initiatives? So this is our perspective. but it's only a small perspective. And that's why we've got this illustrious panel here to share a much broader perspective. And I'd like to get Tebogo to come and join me here. And I'd like to hand over to him so that he can start to frame the discussion, frame our publication, which we're very proud of, which crowds in the full ecosystem to try and put more voices to this question of, how do we make life substantially better as investors and fiduciaries? Thanks, Tebogo.
Thank you, Khaya, and very warm welcome to everybody from me as well. My name is Tebogo Naledi, as Khaya has mentioned. I'm the Managing Director of Old Mutual Investment Group. We're all here, as we know, for the launch of the 6th edition of our Tomorrow publication. This is a thought leadership publication, and we aim to really pull together contributions from a diverse range of authors and focus on themes that we believe are critical to attaining sustainable long-term growth. This year, we are very proud to have 21 authors who have contributed 16 insightful and highly thought-provoking articles, which are centered around this edition's theme, which is building resilience. Now, as we approach what many would call the 15th month of 2020, and as we approach the first anniversary of lockdown in South Africa and in many other parts of Africa, one word that is very apt right now is the word resilience. The COVID-19 pandemic has required and continues to require resilience from us as individuals as we deal with the many work and personal challenges that this pandemic has brought to our lives. Resilience from us as organizations as we strive to continue to play our role in an economy that has been challenged like never before. Resilience from our information technology and data providers in this digital world where which we have all become so highly dependent on. And this pandemic has also highlighted the importance of building resilience in our social and environmental systems. And as players in the financial sector, which directs capital flows, we have a critical role to play in this era of building back better. And so the 6th edition of the Tomorrow publication brings together the thoughts and perspectives of asset owners, asset consultants, asset managers, economists, government, industry consultants, and industry advocacy groups. And we deliberately selected such a diverse range of views because we recognize that supporting long-term system resilience requires strong collaboration, and it requires conversations in which the views of all players in the system are heard and are considered, and that is critical. I'd like to sincerely thank all the contributors and all the authors for your highly valued inputs. Everyone participating in this webinar will have received a link to the Tomorrow publication in your invitation. It is also available in the chat bar and is available on our website, www.oldmutualinvest.com, under the institutional tab. You'll also find a number of podcasts featuring the authors, unpacking the issues that are covered in their respective articles. And I would really encourage you all to listen to these podcasts because they really give you further insights into the topics that are discussed in the publication. And so without further ado, now on to today's webinar panel discussion, which will be hosted by Mr. Jon Duncan. Now, Jon has been with Old Mutual for exactly 10 months this month. Jon, I was actually checking, 10 years this month of February. Jon is the head of responsible investment at Old Mutual Investment Group. He leads a team of 5 professionals that are dedicated to Old Mutual Investment Group's responsible investment program. Now, the responsible investment team's role is to drive the systematic integration of material, environmental, social, and corporate governance issues across our business's funds under management. And this includes sustainability research, company engagements, and industry engagements. I shall leave it to Jon to introduce the topic of discussion for today, as well as the esteemed panel that will be joining him. Thank you all once again for joining us today, and really look forward to a great panel. Jon, over to you.
Tebogo, thanks very much. Appreciate the kind words of introduction. I'm very excited about the panel today. So just briefly, by way of introduction, we have Yanina Vuyantoy, as a co-managing director of African Infrastructure Investment Managers. We have Thabo Ngalo, who heads up the strategy team at Old Mutual. We have Monique Matthijs-Graaf, who is a South African, previously used to work at the PIC, is now an impact sort of advisory specialist working abroad. And we're waiting for one last panelist to come up. Janina Slawski, head of investment consulting at Alexander Forbes. She advises, a large range of clients on a whole range of strategic sort of asset allocation decisions across the South African economy. And then we have my colleague Thabo, who heads up investment strategy at Old Mutual, oversees some 250 billion of capital across the South African economy. So just want to check that we have all panelists on board. While we're waiting for Janina to join us, let me also welcome our audience. Welcome, Janina. Thank you. Appreciate you.
Good morning, everyone.
Good morning. And so I'd also like to welcome our audience. As was mentioned earlier, this is a collaborative discussion. Not any single one of us have the clear answer to how to solve for long-term system risk. And so collaboration is key. From an audience perspective, I really encourage you to be interactive. We've got one question already being asked. Please pop your questions in there as this conversation flows, and we'll try to respond to them as we move. From a structure perspective, we intend doing 3 rounds of discussion. We've got a really interesting, diverse group of panelists, asset owners, asset consultants, industry specialists, asset managers on the ground. So nice views from across the industry. We're going to do 3 rounds of conversation focusing on 3 kind of broad categories, all aligned to the theme of today's panel, which is solving for impact. The first round of questions is going to focus on the broad financial ecosystem, what's shifting, what's the role of the various actors, etc., and we'll gather contributions in that way. We're then going to sort of do a deep dive into the practicalities of investments. We can't talk impact investing if we're not having an investing conversation. So what are the practicalities that actually sort of manifest in that space? And then the last area is sort of a deep dive and focus on impact itself. How do we dimension it? What are the priorities? Where do we focus? Really looking forward to that. In terms of just kicking us off, I'd like to maybe sort of seed the conversation with a few sort of opening comments, and then we'll go into our first round of discussion. So I guess the first thing I'd like to draw listeners' attention to is this idea of systemic risk. We're in a world where the interconnectivity between the market, the environment, and the social system is now a lot more visible and transparent. COVID as a biological system risk has manifested in a very real market risk, and we see that by way of the scale of financial, fiscal stimulus response. So the first sort of issue is around system risk, and I think we're at a point now, sort of collectively from a humanity perspective, where the system risk is visible, and the financial sector is starting to become a lot more clear around its role in supporting that long-run de-risking process. I guess the second sort of point is this idea of green growth, the idea that kind of has really sort of stepped forward following the global financial crisis, where deep questions were being asked around the role and purpose of capitalism. Can we direct? It's not just the quantum of growth; it's also the quality of growth. How do we direct a growth path that is resource efficient, socially inclusive, low carbon? This is a narrative that continues to gather pace, and we see many governments placing it at the center of their the economic growth strategies. And as we heard earlier, this idea of building back better is a question that is being knocked around across all political spheres. We are, $7 trillion of fiscal stimulus is flowing into the global economy. How do we use that to solve for resilience? And then the last 2 points is this idea that the investment industry is shifting. We've come from a world where it was previously just risk and return, but now it's risk, return, and impact. And this idea of the efficient frontier is no longer just a 2-dimensional thing. We've got 3 different sort of 3 different categories that we need to be thinking through: risk, return, and impact. And then the last point, and I think it sort of is evidenced by the introductions that have been provided and by the stakeholders we have on the line, which is this growing sort of awareness that humanity is at its best when we collaborate. And so we've come through an interesting political period globally where the potential for that has been quite subdued. But it feels to me that there's a shift. And this idea of multilateralism being critical for solving for some of the big global system risks is key. And we see increasing amounts of that kind of cross-industry collaboration. And so, I've been at Mutual for a decade. We made a lot of great progress, and that's through internal collaboration across our teams. But I'd also argue that the bulk of our progress has been facilitated by the partnerships we have with clients, with consultants, with the media, with our competitors, with regulators. And so realizing that we're all in this together and solving for, appropriate risk return for our clients, but also delivering impact is key. So with that as an introduction, let's kick off the first round of conversation. And the first round, we're going to focus on, I'm going to ask each of the speakers to talk from their perspective. What's your perspective on this narrative around green growth, low carbon, resource efficient, socially inclusive? How are you engaged in this space, from given your current day job? And what kind of system shifts are you seeing? And what do you think the role of the various actors are? And so, Monique, maybe I can start with you and then go to Janina afterwards. So curious to hear your thoughts. Thanks, Monique.
Yeah, good morning, everybody, and thank you again to Old Mutual for this incredibly significant and important initiative. As Jon mentioned, I've transitioned from South Africa to the UK, working for the Impact Management Project. We're currently facilitating a group of global sustainability standard setters, 16 of them. Yes, we are working with the beloved alphabet soup to try and bring cohesion and a unified system that ultimately ensures, doesn't matter what part of the economy you operate on, whether you're in capital markets or whether you're representing a broad range of stakeholder groups, that there's improved ease in our ability to understand at the end of the day the impacts we're having. Not in ensuring that we don't have this proliferation of new initiatives jumping up that nobody can quite fathom. But to put it more simply, I think, and bring it down to what we're experiencing and seeing the shifts are currently is, we are all furiously racing towards the G7 in June this year, and ultimately COP26, which I think brings it down to more of the topic of today in terms of the green growth narrative and climate change, and the ability both from a structural government perspective to ensure that the right regulation policy shifts are occurring, but also that we're able to be very realistic and practical about communicating, whether it's scope 1, 2, 3 emissions and what that looks like and what that means. However, I think what's been interesting and what's noteworthy is the shift in the political regime in the US, the Biden administration coming, has brought some really interesting momentum. And so it's a very, very exciting time. So as much as I think you will hear me talk about the complexities of this shifting system, which is moving together, we recognize the pace is slow. But there has been opportunities amidst all of the substantial challenges that humanity faces with COVID, in the recognition that something needs to be done and done fast. The US Biden administration coming alongside that means that there's greater global cohesion. And how is that manifested practically? So practically, in the context of what we've seen and experienced, there's been a few things that's been noteworthy. The EU taxonomy, along with other global taxonomies, where we're starting to have a better language around what do we mean by climate, how do we prevent climate washing, so that asset managers like Vuyo, like Tabo, like and the administrations and the politics and actually enacting their fiduciary duties in saying we are investing in climate assets, and therefore we're doing it in a context of a regulation where the systematic risks and the externalities are being managed through the EU taxonomies. That is shifting more into regulation, and it's not just in the EU. We are seeing it across emerging markets and across other developed markets too. We see organizations like the PRI starting to be more deliberate and specific about what does that mean as an investor, giving suggested standardized frameworks to implement that increasingly. And then you've got other organizations like the World Benchmarking Alliance, nascent in what it's trying to achieve, but giving real tangible benchmarks to say, if we're going to attain global standards, ensure that systematic for all the SDGs we're targeting and aiming towards, including growth and climate, we understand what good enough is, and that you can be confident in attaining the fiduciary duties, that they are the benchmarks and this is what they are. So I leave it there to say that it's a very exciting moment in time, both politically and practically in terms of what we're seeing.
Thank you, Monique. And, we're lucky as South Africans to have one of our own there in the alphabet soup. So thank you for fighting the fight. So Janina, across to you. From where you're sitting in the asset consulting space, curious to hear from you around, what shifts are you seeing on the landscape? What does this green growth narrative practically mean to you? How are you engaged with it? What shifts are you seeing? What's the role of the various actors?
Well, thanks, John, and welcome to everyone, and glad to have you joining for this event. It's an incredibly important topic, and I think one that has developed dramatically in the last few years, and definitely will move dramatically post-COVID with the need to rebuild. So I think everything that Monique has been talking about is absolutely critical. I love the words practical, simplistic, realistic, and really tangible, because that's, I think, what clients have struggled with. I mean, they take their fiduciary responsibility incredibly important to them, but they have to make sure they're getting great returns for their members. That's why they're there. So for a long time, it's yes, let's try and see if we can be responsible. Let's also make sure we're doing the returns. But John, you speak to talking about risk return and impacts. I think there's been a growing realization that risk return has to realize that if you're not being responsible in your return, there's downside risk. So long before that sort of phrase has come into common literature, there's been a lot of focus on how can we shift towards impact. But it's difficult. I mean, a lot of clients don't have governance budgets. They can't go and kick the tires on renewable energy projects, etc. They've really got to find investable, liquids, opportunities, and then rely on asset managers to do the right thing. And I think that's where the measurement is going to become so important, because every time a manager comes and presents and talks about ESG and integration and etc., and then they present a portfolio that's got oil in it, it's got tobacco in it, it's got emissions in it, etc. So I think there's a growing realization and almost a desperation from client side to say, give us something that's investable, then we will be responsible, we will look to impact. But right now it's quite difficult to achieve. So I think we are at a tipping point, and it's a very exciting time to be there. Thanks.
Yeah, so I'm hearing you say something about the shifting narrative in the client side, and then I'm also hearing you pointing towards kind of the innovation potential and opportunity on the asset manager side to actually bring forward those products that have got impact baked into them.
That's that's critical. No one can do it by themselves. Also, consultant clients, asset managers.
Great, thanks, Janina. So maybe I can sort of turn the spotlight towards Thabo, as on the asset owner side. Curious to hear your perspective.
Great, thanks, and good morning, everyone. So I think obviously from where we sit, I represent our policyholder funds, which are pretty much a large pool of Old Mutual's live businesses clients. So these are over 7 million lives, 7 million customers, as you can imagine. Old Mutual being a 175-year-old business, the client base and the lives, I guess, we reach both across South Africa and across the continent is quite large. So we have a big responsibility to direct that capital in a responsible way. And one of the big things I think we look for is how do we do that, and how do we act responsibly from not just being a corporate citizen, but also being a great asset owner. So as you know, the old saying that with great power comes great responsibility. So I think I lean on that quite a bit to think how do we what actions do we then take? And we put responsible investing at the core of our strategic asset allocation and the way we allocate our funds. So if you look at the actual people we represent or the clients we represent, you take, for instance, our pension funds. I mean, we represent in our pension schemes just under 500,000 members. So we have a big responsibility to direct their capital in a way that is socially responsible, but also speaks to what members across our different schemes, what communities actually need. And if you look at where the world is going, it's pretty clear that social investing, investing for climate change, investing to give more voice to certain aspects such as corporate governance. And even on top of that, things such as investing through a gender lens sort of base. Considerations such as how many females do people have on their boards. These are very important questions that we need to be solving. And the chain, fortunately for us, it starts with asset owners. As asset owners, we need to set the right tone, we need to set the right mandates, and we need to direct the strategy to the right pockets where we know our asset managers can execute. So I think that all these shifts, and I think some of the major shifts we all know about, things like obviously climate change is quite top priority for us. You think about where the world is going, we live in a bit of a pressure cooker. If we don't do something about it soon enough or right away, we are going to be in trouble, and our kids are going to be in trouble over the longer term. So that's a big responsibility, including all the other social causes, the health effects coming from things like COVID. How do we act on issues like that? So we think about it broadly and how we integrate that into our investment strategy. I think just the last point in the intro that Jon also raised was this whole big shift in the world around risk, return, and impact. That you're not just setting investment strategy on just a standard deviation at risk and what your expected returns are. It's really important that you balance both your risk and return with what underlying social impact or what social goals are you achieving, and that's becoming a big driver and perhaps the biggest shift. I mean, you've seen great letters, for instance, from BlackRock, Larry Fink, being a very important advocate, and we need such strong voices directing and speaking quite a lot for some of these big issues we should be advocating for, not just return and not just risk, but bigger issues. Yeah. Thanks, Jon.
Tabo, thanks a lot. I mean, and thanks for bringing the voice of your customer into the room. I mean, let's not forget, this is not our money. We are fiduciaries. We're acting on behalf of others. And we're typically looking through the lens, in the institutional space at least, through, it's not it's a multi-decade lens that we need to be thinking. So let's bring it down to the ground, the man with boots on the ground. Mr. Ntoye, thanks for joining us. I'm curious to hear your perspective, as an asset manager in the asset management space.
Yeah, thanks for the intro, Jon. As infrastructure investors, we're sort of right at the pointy end of ESG. The big projects we manage are embedded in the communities they serve. They have significant economic impact and employ lots of people. And we are a potential driver of kind of sustainability in the communities in which we are active. So I'd say as a business, we've been around for the last 20 odd years. Sustainability has always been a key part of how we operate. But, within our ecosystem, though, we've seen quite a shift in terms of how ESG and sustainability is really a catch-all for inclusion and how we treat the environment. I think in the early years, it was more a tick box exercise for everybody, including parties who gave us funds. They'd sort of tick the box that we were looking at sustainability. What we've seen, though, is with the passage of time, we've noticed that sustainability within the communities we serve is a key risk management tool. So I think about 10 years ago, risk mitigation was a large part of why we tried or we sought our projects to be sustainable. Was, if you're sitting in a community and the community around you is not happy with the project you've put there, if there's environmental degradation as a result of the project you've implemented, your project's not sustainable, and at the end of the day, your investors will not get the returns they're seeking. So risk mitigation became sort of the other end of that two-dimensional risk return measurement. However, I think what we're seeing more recently is the fact that impact is actually sought and measured. So it's less about risk mitigation. Yes, risk mitigation is part of it, but it's really about seeing what impact we have on the ground. Are we directing capital in a way that has the best impact for all stakeholders, being our clients, employees, etc. So that's really been the shift from tick box to risk mitigation to now a more holistic measuring of impact, and that's sort of been the transformation we've seen. We've seen a transformation in how we raise money. So asset owners such as Thabo and Janina ask us, what sort of impact will the money we're putting to work have in how we spend money? Are the projects we're looking at environmentally sustainable? I mean, over the last 10 years or so, we've seen a complete shift away from coal, for instance. I mean, coal power projects were still being implemented a decade ago, and none of the banks or reputable equity investors will look at coal-fired power stations or even the value chain. Even coal terminals are difficult to finance now. So, in terms of where we can spend the money, it's changed a lot over the past decade. From a harvesting of returns perspective, Khaya spoke to inclusive growth. So there's a focus on sharing those benefits with the community in which you operate. It's either through community shareholding in projects, corporate social spending within the projects, and within the asset management business itself. So I'd say, green goals have really affected how we work. But due to the kind of business we are, I think we're very well positioned to take advantage of that. And the products we've been offering have essentially been green growth products all the way to 20 years ago.
Yeah. Thanks for that. I wonder if maybe we can stay with you as we kick off the second round, because it's sort of a nice segue, and maybe we'll just go in reverse order here. We'll come to you. We'll come to Thabo and then Janina. So, I mean, the second piece is around issues of investability. So as you're looking out across the African continent and you're looking at sort of opportunities to place capital for your clients, I mean, what are the, and I'm thinking with an institutional investor hat on here, what are the kind of key issues that you're considering? What's important to you? Is government support, government legislation? What about issues of blended finance? How have you seen shifts in terms of the way your clients want to contract with you in terms of baking in reporting requirements and the like? Curious to sort of, if you can maybe speak to a little bit of the practicalities on the ground, Is your investment universe growing? How are your clients trying to sort of tie down the sort of impact metrics? Yeah, if you can maybe.
Yeah, I think maybe talking to the metrics to start with. As I mentioned previously, green considerations were seen as more a risk mitigation tool, whereas investors are now seeking and looking for the measurement of impact. So in terms of our reporting, it's incumbent upon us to ensure that the projects we invest in are able to in a verifiable way, measure the impact that they have on the communities, both environmental, how much they contribute to the fiscus, their hiring practices, are they diverse in their hiring practices, etc. So there's a whole number of metrics that we specifically look at to ascertain how the projects we're investing in are performing over and above the financial performance. Maybe getting on to, Monique spoke to practicality earlier and simplicity. Practicality is a key part of our considerations. So I think I spoke about coal earlier, and as an investor, obviously liquidity is key. And it's liquidity upon selling those investments you're involved in. And one of the key considerations we make when looking at investments is whether, we, in some of our funds, we're sort of private equity-esque in the sense that we take on the early risk portions of projects, we build them, we operate them, and then we exit them. So if there's a risk to exit by virtue of the nature of the project you're looking at, it's a very key risk element in our investment decision. And what we found, I mentioned coal projects, is that if you look out for any investor or party to buy into a coal project now, you'll find that it's close to none.
Yeah.
So that's where the practical considerations of where kind of green considerations are going is important in our investment philosophy. I mean, a key part of it is now, I mean, we're the largest investor in renewable energy projects across the continent, both in South Africa and continentally, and we're very proud of that. We do understand, however, that for instance, green projects do have an element of intermittency, and they need to be balanced by something on the load, for instance, especially in countries with small transmission networks. So a key consideration we've been having of late is, what's the impact of gas? I mean, gas is a thermal technology, maybe nowhere near as quite as polluting as coal, for instance. But do we invest in gas assets now? And what are the implications in terms of them potentially being stranded assets at some point in future? So green considerations are a key part of our investment decision making, and I hope that sort of example gave some sort of flavor of what we're looking at.
That's fantastic. I mean, you're really kind of nailing the sort of complexity of the stuff. I mean, you're deploying capital sort of the 10-year horizon. You need to be very sure that there's an exit path, and being wide awake to the transition risk is part of that fiduciary responsibility. So, Thabo, let's come across to you. I mean, from an investability perspective, I mean, where's the conversation sitting with you right now? What are some of the things you're thinking through in terms of governance, legal structures, liquidity, et cetera, et cetera?
Yeah, thanks, John. So I think for us, the main thing is we probably don't have enough products that meet some of our ESG needs, and I think from an asset owner perspective, there's this flood of money that's about to hit the asset management industry. And the biggest thing there is how does the asset management industry create products for us as asset owners that tick off or that tick these goals we want to achieve. So if you look at South Africa, for instance, from a product perspective, we're lagging quite a bit around ESG funds or even climate change funds, etc. So there's still a lot of catch up, I think, from us finding managers that can manage this capital in this growing space, and secondly, the right products, the right products that deliver the same kind of risk return dynamics as we mentioned in that sort of triple lens around balancing both the risk return and then the impact. So there's still a lot of, I think, work, particularly on the local front, on the African side, that a lot of work that needs to be done. I mean, if you look at, for instance, if you're looking to invest on the JSE and you're trying to invest in schools, you pretty much have about two groups. You probably have a Curo, you have an Advitech, and that they don't really give you a nice flavor into investing in education. So one of the great things is you then have to look privately. Are there private funds that can get me exposure to different school groups that are in townships, that are in various areas that meet the needs? So I think there's still a bit of a gap between the product range, and from an asset owner perspective, we're asking for these products, and there's still a bit of a lag, I think, from the industry delivering a product for our managers. And some of this demand now, we think is starting to come directly from the direct beneficiaries and pension fund owners, an example, where you're finding pension schemes and trustees are being very vocal now about what social causes they need achieved for their members. So we then obviously have to translate that into an investment strategy that can fit into the appropriate product. So that work still needs to be done. I think the last point you mentioned, John, are things like benchmarks. So you still have a massive challenge in how you invest and which kind of benchmarks you invest against. So if you look, for instance, at capped SWIX in South Africa, there is no alternative decarbonized version of a capped SWIX, And if you're going, for instance, to allocate capital and exclude some of the big carbon plays, so just very names like Exafo, Exaro, etc., then you run incredible benchmark risk against what your underlying beneficiaries and clients have given you a mandate to do. So there's still a bit of work working with the industry in general, working with exchanges across the world, across Africa, on how do we then create also appropriate benchmarks that we can measure our products and our portfolios against, versus what we currently have. Yeah. So I think those are, let me stop there, but those are some of the first high level issues that we face as asset owners.
Yeah, that's great. I mean, the issue of benchmarks is something that's quite close to my heart. Janine, let's bring you in here. I mean, you've got a visibility across the market. I mean, what are the sort of practical investability considerations that you see popping up from an institutional perspective?
Well, Tabo took all the good stuff, so I'm going to have to find a different angle, because obviously that is a lot of the challenge. So one of the things we look at, particularly where we've got clients that are investing passively, for example, is invest in a ESG index. And obviously it's much easier internationally. I mean, just a tip for anyone on this call, if you invested in a passive mandate, ask if there's an ESG version, and often you can get them for the same price, and that's immediately leaping you into a decision to go very much responsible. Or subject, of course, to the measurement of the ESG being one that ends up being appropriate in terms of Monique's focus. So that's the one issue. But the other issue, which I always need to talk to, is liquidity. As you'll know, in South Africa, there's a lot of talk about investing into infrastructure. I mean, that is real impact. That is what's going to save this country post-COVID. But then the question gets asked, why are retirement funds not investing into these investments already? Is it because there's a lack of investment? Is there a lack of training? Is the risk return not sufficiently attractive? What is it that we need to fix? And there's a lot of work that's being done. I mean, the SIDS initiative, Infrastructure South Africa, will get investable projects to investors in the right way, right risk return, etc. But still a lot of retirement funds won't be able to invest because of liquidity. And unfortunately, we're in an extremely stark situation during COVID, where retrenchments is something we're dealing with every day. Alexander Forbes obviously is a very big administrator, and that's all we talk about at the moment, is which of our clients is retrenching and which one isn't going to survive. So in those sorts of situations, having any money locked into a great impact investment fund, infrastructure, social development, etc., we can't get your assets up for 10 years, becomes an issue. So I think a lot of what we're trying to get the focus of the industry on, and I'm speaking to everyone who's interested in this, is trying to find liquid alternatives. So let's set up big infrastructure funds that have large allocations to liquids, but also create opportunities for liquidity, that you got the smaller funds can invest into them, get the great returns, do the great impact, but also where necessary be able to take assets out. So I think we really need some creative thinking, financial engineering, and that will allow everyone to step much further along the impact space to really invest and create opportunities for South Africa to recover.
Thank you, Nina. So, Monique, obviously you're not directly involved in sort of, directing capital, but I mean, just, any high-level comments on what you've heard around the challenges of investability and practicalities around that?
Yes. Yeah, no. Firstly, I think my heart skipped a beat when Janina said financial engineering, because I have been involved in deployment of capital, and I was an equity analyst, and I lived through too many bubbles thanks to financial engineering, and it just makes me nervous, and I do laugh, because it is what we need, and it's what we're seeing in these blended finance instruments, and it's fantastic, and I've been part of trying to get them scaled up as part of the impact investment movement, etc. But I'm not sure it gets us there in terms of the scalable liquidity solutions we're needing. And there's a little bit of a drag that it presents. But what really, for me, hit the mark completely on what Janina spoke to was this increased impotence of getting the instrument right in infrastructure. And so it's interesting, because there's, again, just to link back to what is occurring globally at the moment, is that the UK has just released a Mobilis fund, which is about creating liquid listed impactful instruments in emerging markets, recognizing that this is a gap. And obviously it's a broader gambit, it's not just infrastructure, but it's recognizing that this liquidity issue is increasingly becoming the opportunity that once we solve for, we get scalable capital release to solving climate and a range of the other social issues that the beneficiaries of the capital we manage is really wanting us to solve for and being more creative on. And so I wanted to pick up on two things as well, like for you and Tabo talking to. and I'm gonna catch it on the heading of EV, electric vehicles and enterprise value. Two very different things, but I think it brings to this discussion together so well. There's this analogy that goes around in these kind of systematic sustainability discussion now around this boomerang effect, that whatever investment decision you make, whatever asset you own, whatever economic activity a company undertakes, they have an impact. Whether they like it or not, there's often, you let's talk about a car. You would produce a car, and as a result of that, you're emitting carbon, right? Ultimately, that means it comes back and you need to go and reclaim those components of those vehicles, if you think about the AutoCAD process, and there's a cost to that organization in that manufacture that. But the boomerang effect is often with teeth. It picks up a whole range of other issues, which you didn't even think you created when you made those cars, right? So now you've got to solve for climate change and reporting on your scope 3 emissions and finding all of that information, etc. And I just mentioned that EV vehicle example because it's something so practical. Living in the UK, I was astounded. I go to a park and I see that there's actually a place where you can charge an electric vehicle car today. And the scale at which they're rolling it out. We had an announcement here that within 3 years, one of the largest car manufacturers will no longer be producing combustion engines. They will only be selling EV. And so it's a reality which I guess, coming from South Africa, we saw, but it felt like it's far on the horizon, whereas here it's upon us. So when we think about these green solutions, it's no longer, for me, as we think about the coal transition, and we discuss it, and I think that's been an imminent language and context for South Africa. If we think about that in the context of liquid investment, what's so fascinating for me, if you think about our ability to invest in the JSE, whether it's passive index-based, is if you wanted as an institutional investor an asset class of investment which is purely green, renewable energy focused, etc., on the JSE, there isn't a single instrument you can own there, is there? And there's been attempts at those through SPACs, etc., but we haven't been able to grow that substantially and significantly. And so we've worked on these sort of ESG adjusted, etc., instruments. And so I just highlight that, and I just flag that what's possible. I think what institutional investors include for, and I love that just ask for the ESG version of your passive investment, right? Because that makes a leap change. But then I wanted to come back, besides the EV, the real green practicalities of what we need to still transition to is the enterprise value discussion. Because linked to this boomerang with teeth analogy is this concept of what we're going to start measuring and how we're going to standardize that, and who ultimately owns responsibility for what. Because increasingly, if we think about the end beneficiaries of the wealth we're managing, ultimately when they retire or when they need to make a call on the policy because life has happened for them, is that they're wanting to know that they didn't just get their baseline plus an inflation return back. They're needing to understand that by virtue of the significant percentage of GDP represented by the wealth that you've managed, that there's been something more in the society that they're living in. And those are realities like Tabo spoke to, that, do I have an affordable price point, given that we know, given the substantial unemployment in South Africa, they looking after the education of probably their grandchildren, probably still their children, the healthcare of their aged parents, and are we being very deliberate about what the value creation component represents? And so just to touch on, I think, an important development in the detail.
Monique, I'm going to have to sort of pause you there for a second, just simply because we are running towards the top of the hour. And I want us to maybe maybe you can work your final comments into this last round of comment. You're touching on absolutely important thing here, which is that, there's a macro thematic shift underway here. We need it because society and science is telling us this has to happen. But also there's a real economic opportunity, as in companies that are producing goods and services aligned with the green economy have a tailwind and a growth opportunity, and placing capital behind them allows us to deliver risk return and impact. So if I think about impact, there's net impact, which is the positive impact, and then there's also the harm reduction, So reducing the carbon intensity of a listed equity fund versus a benchmark is an example of a impact reduction, which is measurable and has a place in the impact world, as does effective listed equity stewardship. It's a measurable So when we think about impact, and this is, and I'm going to ask each of you if you wouldn't mind just landing on a closing thought here, which is, you know, as you think about impact in South Africa, where's the area to have the best possible impact, which asset class? And from where you're sitting, what do you see as the key sort of impact priorities? And so, Yanina, maybe we can start with you and then come to Thabo. And if you can maybe just sort of also land in a concluding comment, because I think this is probably going to be our last round before we get to Q&A. Oh, you're on mute, Yanina. Hold on a second. Let's get the studio team to unmute you. Thank you.
I don't know if I did that. So I think we've covered it to the extent that, I mean, where you can really make an impact is where there's investments that are going into impact. And as Thabo said, there's not many listed shares that actually give you the ability to invest into them. A lot of times clients would have to look at unlisted in the equity market. Obviously, in the bond space, there are many SOEs, municipalities, and private sector that are investing, but sometimes you feel like you're having less impact because you're just waiting for your coupons to come back. You can't vote on your proxies, etc. So there's a range of options, and I think, as I've said before, it is liquidity and it is a passion that clients are bringing to the table, but they need solutions. So most of my clients won't be able to have the governance budgets to go and do a lot of the detailed investigation. They rely on their asset managers. The yes asset managers talk to ESG, but also talk to ways you're finding ways to find these investments, listed or unlisted, bring into some of the portfolios. And then I guess a final comment on impact. Anything I read in this space that talks to the fact that we all want to live in a world that's going to give something better for our children in the future. And if we don't, as investors, as advisors, as asset managers, find ways to make more impact, whatever the issues with liquidity, etc., then none of us are going to have children living in the world that we wish for them.
Thank you for that very powerful thought. Thabo, from where you're sitting, if you think about impact priorities for SA, I mean, what's sitting with you at the moment around that topic?
Yeah, so thanks, John. I think the way I'd look at this is what sort of social ills or social problems do we face, both in South Africa and as a continent? And there are massive challenges if you look across the continent around infrastructure, as an example. Issues like power, you know, how do we power the rest of the continent? So I think those are some of the social changes. I would look at this question more from a bottom up. If you look at South Africa, for instance, we have massive challenges around poverty and inequality. We've seen healthcare, etc., where, you know, throughout COVID, where we've sort of seen the gaps in some of our municipalities in the healthcare space. And also, I think things like cleaning up the environment. You know, South Africa is a very interesting country in that we are a massive polluter from a coal perspective, but our GDP is not as large relative to some of the large polluters in the world. So I think if you just sort of lay these issues on the table, you start sort of mapping out what kind of priorities would make sense for us. So things around private funds, you know, for us to achieve some of the goals, around some of the social challenges around education, etc., meeting these gaps, we need to get primarily private funds to come in and fill these gaps, you know. So if you look, I mean, I mentioned earlier that it's very difficult for the JSE to address a lot of these issues, you know, because I think we have a JSE that's very heavily weighted towards certain sectors and doesn't necessarily direct capital properly towards some of these social challenges we face. So I would see private markets being a big issue. And I think this is where we start needing regulation to come and assist us in, for instance, giving more allowance for private investment or for allocation into private investment, particularly private investment that has a social cause, you know. So I think a lot of these things are some of the shifts and some of the impact areas I'd see us directing capital into. I spoke about pollution and of course the big issue around coal in South Africa and climate change. The fascinating thing around climate change and social issues from an ES perspective is they're incredibly linked, you know, and of course there's a governance part that comes to it. But just to just stick on the E and the S, I guess, you are finding like what Monique was saying, for instance, how do we deal with a just transition? So, I mean, as more and more of us, I mean, I imagine most of us on this panel or even on this call in probably 5 years' time will probably be sitting in an electric vehicle. you're starting to see the charging station popping up everywhere. Now, the question you ask yourself is then, how do we transition and what do we do with this real estate that petrol stations occupy on our corners, in every corner, in every city, in every suburb? And importantly, what do we do with these many, many petrol station workers, these gentlemen and ladies who work in these petrol stations? How do we transition them into a new world, you know? So I think all these issues are related, and the way I think we're thinking about it is you have to think about it in a very holistic way, particularly as you're modeling a portfolio that one affects multiple lives. I mentioned at Old Mutual, you've got more than 7 million lives that we are touching throughout policyholders. So how do you design an investment strategy that has a long-term focus, but that also meets a lot of these social issues that we need to meet? So those are some of the big challenges, John, just to sort of maybe leave it there, I guess, in the interest of time.
Yeah, thanks very much. I mean, we are coming across to you, and I'm going to ask you to also perhaps maybe respond to one of the questions that has come up. And it's really just this issue of, pay-as-you-go solar companies. So the broad, obviously, this closing round is around, where's the best area for us to make impact with capital? And obviously, you guys, given your investment lens, have got a particular focus. But one of the questions that's come up here is, how do we invest across Africa? And there's a question here around, do we invest as pay-as-you-go solar, or if I would kind of frame it as off-grid solutions? So kind of curious to maybe get a closing comment from you, and if you were able to maybe comment on this issue of kind of off-grid or pay-as-you-go solar.
Thanks, John. Okay, wonderful. Yeah, I mean, maybe to answer the question first, I think we don't take a macro view on countries on the continent, and I should have probably mentioned that we believe in a sort of boots on the ground understanding of the dynamics of the various countries we operate in. So we don't have a one-shoe-fits-all solution in terms of energy solutions for countries. Some countries have significant rural populations where mini-grid solutions make better sense than trying to improve the performance of the grid, for instance. And in those instances, we've got companies such as Bbox, which we invested in East Africa, which does kind of household solar installations on a sort of mini basis. Further to that, we are also invested in a company that does commercial and industrial solutions for corporates, mainly in West Africa, but is spanning across to East Africa at the moment. And it's really about solutions that work for the specific jurisdiction. But I think on an overall basis, we're very keen on green power and alleviating the energy starvation of many communities across the continent, even here in South Africa, where I think most of our investments are in sort of grid-tied large renewable projects. But we've also got a company we've invested in, Orionis, and you might have seen in the press recently that they did a commercial and industrial solution for Amazon, where power is being wheeled over the Eskom network, renewable green power to power their data center in Cape Town. So, I mean, I think we've got creative partners who look for bespoke solutions for specific jurisdictions and clients. But overall, on an overarching basis, our approach to making these investments is green and very impact driven. And maybe just in closing, I think you asked about the areas we can affect most in South Africa, and I think Thabo spoke to most of them. The issue of climate, and people in the Gauteng region would have kind of I think there was a big sulfur smell in that part of the world over the past week, and it's part of the greening solution we're talking about. So climate is quite important. Economic growth and poverty reduction. So power is very important to allow businesses to create jobs. And then again, it's about the quality of jobs that are created in those industries. In building our infrastructure, we create jobs as well, which also has a multiplier effect. And another key item for South Africa, I believe, is governance. And I think if we are leaders as kind of asset owners and asset managers in terms of driving good governance, we almost dictate to government and other stakeholders on how governance should be approached more generally. So I think as the custodians of the community's savings, we should have a louder voice on all matters ESG, environment, social impact, and governance. And I think we as a business are playing our role in driving those initiatives.
Thanks, Khaya. I mean, I completely agree with you. The sort of governance dimension here is really key, and sort of it has an overarching sort of consideration for how policy is formed, for how trustees operate, for how consultants work. And so all across that value chain, if everyone is thinking carefully about their fiduciary duty of balancing, social systemic risks along with financial returns, we start to end up, I think, pointing in the same direction. So Monique, maybe to give you the last word on the panel. See, we've lost Thabo. Yeah, just from your perspective, what's top of mind for you around impact? Where do you think, which areas do you think capital can play the most immediate? Where the low-hanging fruit? Yeah, curious to see what's top of mind for you.
No, thank you, Jon. No, so valuable and true what everyone has pointed to. And just to build on, I think the concluding point for me would be that when we think about our definition as capital markets of value, whether it's enterprise value or wealth value, how do we bring in more specific tangible measurement of long-term factors which affect finance and risk in a way that makes the system we have work better and more efficiently? And I think increasingly we are seeing those possibilities as we have more specific pointers of measurement indicators to draw in to our Foundation and our OSCO process of board. They've come out in January after receiving incredible amount of inputs, many from South African institutions, in support of it, or in support of it with specific caveats around, being very clear about what their scope is and that it's not the only solution to ensuring improved sustainability across capital markets. And so I would just say that, as institutional investors, there's an imperative to be able to define and continue to define value in our world that draws in all of the sustainability topics too. But I wanted to just say, from a South Africa perspective, I think what we must remember is that South Africa has always been the leader in this, as is the African continent. Development has always been in our blood. And I see that as well in the National Treasury, the fiscal division rolling out the climate finance taxonomy. I would encourage every institutional investor, wealth manager to weigh in on that, because it's climate, but it has sucked in a broad range of sustainability, social, environmental areas. It's done so thoughtfully per sector. They're busy piloting and testing it to the extent that you're able to participate in that, do weigh in it, because it presents a solution. It's voluntary. It's not meant to be regulatory prescriptive at this stage, but it's something that will allow that leap stage of both the liquidity, the products, the naming conventions, and keep South Africa on the front foot in this area. And the world needs South Africa to show leadership in how this transition can be done pragmatically and realistically and inclusively and sustainably. And my last comment would just be to say that what is made possible by man is made lasting by institutions. To hold that long-term lens of justice for the beneficiaries is a unique position that you as institutional managers hold, and to really carry that to the end. Thank you, Jon. Thank you to the panelists.
Thank you. Thank you all very much for your contributions. We've got a little bit of time to take one or two questions, and I'd also sort of invite the panelists to consider if there are any questions you would like to ask any of the co-panelists. If you maybe can give me just a show of hands, that would be helpful. Just put your hand up if you would like to ask a question, one of the panelists. In terms of questions, there's a question on the list here, which is a query around digital infrastructure. Are we sort of actually, considering carefully the requirements for digital infrastructure build out? What kind of opportunity does that present across Africa? Vuyo, I'm wondering whether you, from an on the ground perspective, have possible some comments there. Thabo, similarly, and Nina, if you've got anything to add, I'd welcome that.
Yeah. Okay. Thanks, John. Yeah, I mean, it's a topical question, I think. We just signed a deal to acquire a tier 1 data center in Ghana yesterday, so in our Pan-African fund, so very topical. I think in recent months we also announced the acquisition of a significant stake in Metro Fiber, which is a fiber to home and fiber to office operator in South Africa. So digital infrastructure is a key theme for us. I think the advent of COVID and telecommuting, as it was, has brought digital infrastructure to the fore as an investment opportunity, but it's one we've been looking at for a while. I mean, we're also an investor in various telco towers companies as well. Through our funds, and we're looking at additional opportunities in that space as well. So definitely an opportunity. It's obviously subjected to the same impact and social and governance tests that we have for some of our other infrastructure investments. Obviously, from an impact, or rather an environmental impact perspective, it's probably obviously has less of a footprint than a power station, but it's subjected to the same stringent review when determining whether to do it or not. But yeah, and the impacts are clear. The fact that we're having a conference like this over fiber lines just shows how important putting that infrastructure into place is.
Yeah, I mean, look, I'm certainly acutely aware of it. Yanina, please, if you wouldn't mind contributing as well.
Yes, I think if you're talking impacts, you're obviously trying to find the highest multipliers. So we traditionally talk about infrastructure because building roads and the ability to build factories with electricity, etc., can make jobs and so on. But obviously what's been really stark in this environment has been that we are all online, but many people aren't online. And at night when the electricity goes off, they don't have a generator that starts pumping, etc. So to look for real multipliers, and obviously it's also in the education space. Again, which children stayed online and poor children didn't have education or perhaps even food or light, etc. So looking for multipliers, I mean, digital has to be one, obviously in a investable, responsible way, but it has to be one of the biggest multipliers for trying to bridge the difference between the rich and the poor, specifically in South Africa, but obviously also across the continent.
Thanks very much. I'm wondering, are there any other contributions on this point to digital infrastructure? Thabo, have you got any contributions? Or alternatively, if you would like to ask each other a question, now would be a good time. Otherwise, I might draw us to a close and invite my colleague Tebogo. So let's go to Thabo first, and then we'll come to Monique and then Yanina.
No, thanks, John. I mean, I think the sentiments have really been echoed. I think Vuyo is spot on in terms of just the on-the-ground execution. So I think it comes back to the point I was making earlier. I think we need more and more funds that are looking for these opportunities. And certainly Vuyo's business and Vuyo's funds, from an AIM perspective, are really delivering on these infrastructure funds. And I think infrastructure looked at it broadly, not just bridges and roads, but I think also from the fiber, as you said. So I think nothing more to add, but these are obviously bigger strategies that we look to support.
Yeah, and so the curious thing for me around infrastructure, hard infrastructure, is that it's got this kind of social multiplier. And so how does the infrastructure itself support building the social infrastructure and the social capital and that we need in order to have this kind of green economy outcome? But Monique, let's go to you, and then we'll come to you, Nina.
Thank you. And I just wanted to pick up on something that Vuyo was alluding to in that great example of that investment, that it's possible and it's happening. But is this constant lens and discussion, especially from a just transition perspective, of how do we ensure we're still acting to avoid harm while we're contributing to solutions and driving that, and this constant assessment in the framework of what we do every day is important. One of the issues that have come through on the digitization side globally thematically is around our ability to be more specific around what those negative digital policies may be when investments are being increased in this space now, because it is having that unintended negative impacts and consequences, possibly, as Yamina alluded to, where it's increasing exclusion and it's driving inequality unintentionally in certain aspects. But it's just that constant awareness of that nested taxonomy framing that first ensure your do no harms are appropriately managed and assessed, then ensure that your stakeholders have been appropriately addressed as you drive and contribute to solutions. And so, for example, again, the World Benchmarking Alliance has put out a significant detail around the digitization. China presents specific policy issues and ramifications. Africa has, America has, and so there's a wealth of learnings, but also Africa and the continent has so much to contribute as well in terms of what is doable from an investment perspective and how you manage those long-term impacts continuously.
Yeah, it's a great addition. Thank you. Yanina, let's come across to you. I saw you had your hand up.
Just really a question about international investors, because there's been so much focus on trying to get local pension funds to invest into infrastructure in South Africa, but they have a fraction of what is required for the real impact, the 2.1 trillion that this initiative speaks to. So maybe just to be clear, obviously you try to raise assets from international investors, so I'm sure you can speak to that. But just what is it that's going to make a difference to get actual volume of international investment? Obviously, as John, as you say, we're one of the dirtiest, which means we can get a big impact for an international investor wanting to do a green investment, and get the maximum impact in terms of a transition. But also just in terms of risk return concerns, obviously prescribed assets is not helpful as part of a conversation to attract international investors. But do you see any tipping points that international investors will finally see opportunity to make a big difference by investing into green opportunities in Africa?
Thanks for that. I think it's like a sword. It's two-sided. South Africa has both a blessing and a curse. The blessing in South Africa is the fact that South Africa has very deep capital markets and kind of a yield curve that goes out quite far. So long-term investments in local currency are possible. So typically, it means that competition for investment in infrastructure assets is really in favor of people with local capital because the market is so deep. So from a pricing and return perspective, and because of this currency risk, South Africa typically doesn't make sense for your normal institutional investor in infrastructure projects because your local rand-denominated investor is just so competitive. However, I mean, if you look at the renewable energy program, for instance, in South Africa, where there's been upwards of 200 billion rands invested in that process, there's still quite a sizable chunk of international investment there. It's not institutional investment, so it's not people investing in funds, but it's corporates in the sector investing their balance sheets to invest in subsidiaries that engage in projects locally. So it's maybe not the portfolio flows that one would look at a macro perspective, but it is real FDI, and it's foreign companies spending dollars or euros in South Africa. So that's what we're seeing. On the rest of the continent, we have dollar-denominated funds that we manage. So obviously, what tends to then happen is that projects across the continent tend to have a hard currency underpin. which then is also a blessing and a curse. So a blessing in the sense that they can keep interest rates on projects low relative to inflation in countries. But obviously there's the problem of having foreign denominated obligations to investors and lenders, which are typically government guaranteed as well. So it's kind of finding a balance between projects that show good returns in hard currency terms and also really, I mean, we believe that using local currency for local projects is a perfect match. Obviously, there's a natural hedge because you're using the same currency. And we think it boosts local capital markets and local savings as well. So we'd be advocating for local savings to go into local infrastructure in the first instance. But in instances where international capital is required, that whole currency conundrum becomes a bit of a challenge that needs to be managed. And then beyond that as well is the fact that with zero interest rates in the US, private equity and infrastructure funds in the developed markets have really outperformed over the last decade. So they've done the sort of returns you'd expect out of an investment in Africa. So convincing an international investor to leave the sunny shores of the US and come invest in Africa for a return that's very similar to what they're getting at home is very challenging. We do, however, feel that as over time, when interest rates get back to more normal levels, the proposition of Africa as an investment destination to American and European investors will improve. And, this is the story we're telling to prospective investors in our Pan-African funds.
So thank you all very much. Thank you for that. I'm going to draw this panel to a close and just thank you each very much for bringing your voice and your energy to this very important conversation. If I may sort of summarize kind of some takeout points that's come out of this discussion. I mean, the first is that the systemic shift is happening. It's underway. We've got all these little data points right across the ecosystem, from taxonomy development to capital flows to innovations of products. So that's the first thing. The second thing is that it's real and it's happening. Money is flowing and it's probably just the start of a trickle. I guess the last 2 points I'd want to sort of say in summary is that the first is that innovation is key, and asset managers have a tremendous role to play there in terms of innovating and bringing product to the market that solves this risk-return impact conundrum. And then the last thing, which I think this panel has evidenced and a microcosm thereof, is the importance of actors across the ecosystem engaging and collaborating with each other to find solutions. These are long-term problems, and we really do need long-term partnerships. So I really sort of invite you, the listeners, to engage with the content of the Tomorrow publication. Please reach out to us, engage with us, and thank you so much for your attention. If I may, I'd like to hand back to Tebogo to lead us in the closing.
Great. Thanks, John. Am I on? Yeah, that's great. So thank you very much, John, and thank you, panel, for a really robust and an engaging discussion. And thank you, John, for chairing it so well. I'd like to also, just while I'm on gratitude, just to also say a big thank you to the Old Mutual Investment Group staff who put together this webinar and coordinated everything, as well as, coordinating the compilation of this book, the Tomorrow publication. It's really a quality piece of work, and I really encourage all of you to spend your time going through it. There's a lot of good content there. You can spend, a number of days kind of going through it and really getting into the topics there. But the most important thank you is really to all of you, over 200 people registered for this event. And I hope that it was something of value for you and something for which you can, you've got some takeouts that you can take into your respective, areas of work in terms of where you fit in the broader global, in the broader global value chain in terms of delivering on this. Please note that a recording of this event will be made available to you via email next week. And always good to hear feedback from everybody. So if you have any comments you want to make, any feedback you want to share with us, we would welcome that. Please feel free to use the email address futurematters@oldmutualinvest.com. I'll repeat that, futurematters@oldmutualinvest.com, and please do send your comments and any feedback you have. So folks, from my side, thank you very much. To end off, please don't just log off yet. We're going to end off by just showing a short video. So please hang on for that. And thank you, everyone. And we'll see you next year. Stay safe. Thank you.
In Africa, when the heavy rains fall, some people build dams, some build bridges, and some build ships. It's an observation that speaks to the essential nature of people and how they respond to a crisis. Some are cautious, simply looking to conserve what they have. Some expand their horizons, and some make the most of every opportunity. At Old Mutual Investment Group, we see the power of responsible investment and seek to allocate our clients' capital in such a way that they will meet their investment objectives and make a positive impact on society. It's about using investing as a force for good, about imagining a better world, and harnessing money to help make it happen. Investment with purpose today for meaningful returns tomorrow. Old Mutual Investment Group. Investing for a future that matters. Old Mutual Investment Group is a licensed financial services provider.
Hello world, wake me up to another good morning, time to go. Got that smile upon my face, 'cause there's excitement in the chase, this I know. Yeah, I'm going